Good afternoon. This is Troy Eckard. I'm the CEO of Eckard Global LLC out of Richardson, Texas. Today I'm going to talk to you for a couple of minutes about oil prices and where I believe oil prices are headed. As of today, oil is trading on the West Texas Intermediate pricing at about $45.82 as of about an hour ago. This is late afternoon on June the 9th. And there's a lot of forecasters out there that are trying to predict where oil prices are going. And I've looked back over the last 36 months before the oil prices seemingly crashed. And it's been amazing to see that 99% of those that predict oil prices are dead wrong. So I guess it's like weathermen. Geologists, weathermen, and forecasters are wrong 90% of the time, and they get to keep their jobs. So I'm not going to tell you where I think oil prices are going. I'm going to tell you why I think they're headed in a particular direction, and you can use that information to make your own investment decisions. So let's talk very briefly. First off, I believe that oil prices should have never gotten above $50 a barrel. In fact, last year I was telling my partners and industry partners that I believed that oil was going to close around $42.50 a barrel on December 31st of 2016. It did not. It closed at about $51 a barrel. It goes back to me telling you forecasters are wrong. But what I said and what I prefaced as far as why I thought the price of oil was going to drop to $42.50 is in fact still in play, and I believe that is what's dragging down the price of crude oil today. Effectively, we have a large increase in the number of horizontal shale wells that are being drilled in the United States. We're at about 9 to 9.4 million barrels of output a day. We barely had any retraction in our total U.S. output of crude oil, even though we lost 77% of our drilling rigs. Now let's keep this simple, because some of you are looking for information. You're not really looking for a lesson in great detail. Some of you want a more detailed explanation, which I will do in my subsequent presentations. But here's the reality. Each new horizontal well that's being drilled in a shale play is probably drilling 33% faster. They're drilling 33% better wells, meaning staying in zone longer, completing them better, getting better output or better results, and they're doing it at about a third less cost. So if you keep adding a third, and you keep having successful results with a 99% success rate, it's not going to take long to increase the amount of barrels of oil that are coming out of U.S. wells. Now, I'm going to add to that fact the fact that we have already absorbed most of the barrels of oil into the marketplace globally between Saudi Arabia's reduction in the OPEC Accord, as well as Iran coming back into the market with their crude oil. So what we have is we have what I would consider to be a full tank. We've got everybody in all cylinders dumping oil in the market as hard as they possibly can, but yet you look around at the economies of most large countries and they are languishing. Economic growth is very flat in most countries, or very small incremental increases. So if we continue to have less consumption and we continue to have flat consumption, but we increase output, it's supply and demand. There's no question about it. We're going to have too much supply, not enough demand. In this particular country, the reality is we need about 18.5 million barrels a day. I personally believe that if we had the right government policies in place, that we could be completely energy independent within the next 5 years. I believe we could be at 15 to 16 million barrels a day coming out of our own oil and gas wells, and literally have minimal export or import from foreign countries. Now, here's what you're going to do as an investor. If you want to take this information and say, well, what good does it do me? Well, one, I'd be very careful investing in energy companies that have drilling rigs. I would invest in companies that do have workover rigs. What the difference between a workover rig and a drilling rig? A workover rig comes in after a well's been drilled, after it's completed, and its job, like the maintenance man, is to be called back out to fix pump jacks and fix tubing and repair wells. And we keep adding 5,000 or 10,000 new wells a year. Guess what? They're going to be really, really busy the next 10 to 20 years. Drilling contractors are seeing a big increase in the last year over year. Last year we were sitting at 389 drilling rigs, same date, same time last year, same week. This week we're at 916 drilling rigs. That's a significant increase in drilling rigs year over year. That bothers me, okay? And what bothers me is, and by the way, it's not 389 rigs. We were sitting at about 440 rigs about this time last year, so I want to make sure I correct that. But what bothers me is that each new drilling rig being put on and actively used for drilling is probably drilling at an equivalent of 2.2 times old rigs value. In other words, 2.5 rigs, 2.25 rigs, their drilling, their results, their production, their output of activity is equal to one drilling rig today. That's because this rig is the most advanced rig with the best crews drilling at the best prices, whereas these crews were scattered, diluted as far as intellectual assets, and so there was not as near as much impact or effectiveness. If I'm playing the market going forward, I believe you're going to see oil touch right around $40 a barrel between now and the end of summer. I believe that most geopolitical events that could take place have taken place. There's only a couple of wild cards left. That's whatever North Korea may or may not do, which would cause us to have some kind of type of military reaction. I also believe that there is a continuation of abuse on the global market with regard to production output and certain OPEC members that effectively have no disregard for world economy or world peace. And so from that standpoint, there's always that geopolitical event out there that could cause us to jump $20 or $30 a barrel. Absent that, I don't see how the oil industry can swim with big old wooden, or not wooden, but big old steel balls hanging around their ankles called supply and demand. And right now we are completely out of whack when it comes to demand relative to the increasing supply. So I'm Troy Eckard. I'm the CEO and manager of Eckard Global. And what I wanted to tell you to think about today, start looking at your energy investments. Be ready to buy, continue to put them in your portfolio, but know that oil prices, in my opinion, have enough evidence to indicate they're moving in a higher probability down than up. I do believe we'll see up prices, but it'll be 18 to 24 months. Again, have a great week. I hope the information has been of value.